folks. It's Dave Burrows. I am a CEO and Chief Investment Officer at Barometer Capital Management. I want to thank you guys for joining today. As we typically do on Tuesday afternoons, we're going to take a look around the world and see what's going on in asset markets. Quite a day today. This has probably been coming for some time, and a big response to the CPI data. So off the top, let's just start with sort of a big picture view. At the bottom line, I think there's tons of opinions. And the most important thing you can do as an investor is how to have a data-driven process, right? You got to have a process that looks at the world for what it is, not what you think it should be. And we're going to try and do that today. We iterate week to week, look at what's changed, what stayed the same, and then, the ultimate goal is to look at the portfolios as we have them constructed to make sure that they make sense given what we see is going on in the market. Just from a big picture view, we continue to be in a structural bull market that started in 2013. This is the U.S. stock market back to 1900. There have been a series of secular bull markets, multi-year periods where the equity asset class was revalued from being underowned and unloved to ultimately overowned and very expensive. And typically at the beginning of a structural bull market, there's lots of reasons why the asset class has been out of favor for a period of time. Money's left to go other places where it's treated better. But then generally at some point, for every asset class, there are moments in time or periods where there's a structural shift that takes place that ultimately starts to benefit that asset class. And as long as it goes on, not only do we see maybe earnings grow, but we see multiples expand over time, and that's where you get outsized returns. So a structural bull market tends to be like 4 steps forward, 1 step back. Sometimes 1 step back can be painful. If we look at the last 2 structural bull markets, the 80s and 90s and the 2000 sort of 13 through present, we can see lots of interruptions, and interruptions come in time, or they come in price, or a combination of both, and expectations are reset. And then you tend to have, in between these interruptions, long run-ups in price that confound investors as they begin, because typically they begin when the news is bad and when there's been lots of things to worry about. The most recent bear market we've been going through started in the end of December 2021. It's been going on for 23 months. We have yet to make a new high. We're now only 5.6% off all-time highs in the S&P. That's significant. We've been rising since October of 2022, so over a year. Yet there's a lot of people who think this market's going to just get worse. Now, structural bear markets are the things we worry about. And these are the real bear markets. 2000 through 2003, that was a tough go. 2007 through 2009, that's a horrible market to live through. What we have been going through is nothing like that. It's been really tough in certain parts of the market, and others it's been more friendly to. But we got to keep an open mind as to what happens next. Generally, when we get to a new high, ultimately we have several years where the markets make gains, and we want to make sure that we're invested when that takes place. So you don't want to get too vested in a view. The S&P, looking at it under a closer lens, peaked out beginning of 2022. The S&P made a low in October of 22, and that was really around the same time U.S. dollar put in a regional high, and yields started to back off a little. We've made a series of higher lows since then. Most recently, one just only October the 29th, after a 10% correction. We often talk about the fact you're likely to get 10% correction a year, and it always feels bad. But since then, in a hurry, we have recaptured almost all that was given up. So the U.S. Treasury yields peaked out in early October 2022. They started to back off. That's when the market started to rally. Stock market hates a quick run up in yields. It provides competition. It provides question marks. You know, Mohammed Alarian said recently the 10-year treasury has been trading like a penny stock. We don't like to see highly volatile periods in what's supposed to be the world's safest asset. We're now 3 years into a bear market in bonds. And recently, 4 weeks ago, 10-year treasury made a new high in yields, around 4.5%, 4.9%, and started to back off. Again, this was early stage when stocks started to bounce. If you look at the US dollar, generally when the dollar is going up, it's a move to safety. And you saw a near-term peak in October of 22. It got overbought in relative strength and started to back off at the same time yields did, and stocks started to rally. Well, most recently, the correction that started on July 26th, US dollar rallied straight through until early part of October when we made a high. Overbought. We highlighted that about 4 weeks ago. And since then, the relative strength of the US dollar started to wane. Today, a big down day on that CPI data. So yields lower, dollar lower. That takes the pressure off other assets. A couple of weeks ago, we thought maybe we were seeing the near-term peaks in yields. And the question was, well, should we be pushing a bunch of money into bonds? So we did take some short-term cash and move it into 3-year bonds. But we didn't make a wholesale move into bonds because our view was that if bond yields started to back off, there's other assets likely to perform better. In the first week that stocks rallied, you know, the bond market rallied 2.3%, stocks rallied 4.5%. So positive that yields maybe have made a near-term high. The stock market is perceiving that. Positive that the US dollar, you know, freight train rally has run out of steam. That's being seen positively by risk assets. Ultimately, it is meaningful to investors. Now, 2 weeks ago, we talked about the fact that we had this thrust in breadth. In other words, a very high percentage of stocks up versus down over a 10-day period. And when that has happened historically, it tended to mean that we were at a near-term low. When we looked at what you could expect going forward, 21 days out, likely, you know, pretty decent markets, up 92% of the time. When we went out 6 months, it was up 100% of the time and averaged 17%. When we went out 250 days or 1 year of trading, up average 24%, 100% of the cases. So that's old news. Here we are today. Beyond that initial breadth thrust, we've had a couple of days of consolidation, really where the market did not pull back much. Yesterday was a sideways day. Partway through the day, I put up a note on Twitter, and it was a very quiet day prior to CPI. It has never been a good idea to short a quiet market, and quite a day today to follow on with that. From my friend Milton Berg, who does a lot of data crunching and has an incredible grasp of numbers, he highlighted that the S&P declined by more than 10% in the correction and then held its low for 10 days. Following that, it gained in price 9 out of 10 days. And when you went 1 year out, there were 4 occasions where this took place. You can take a look at the numbers, anywhere from 19 to 26% returns over the following 12 months. This goes back to 1960. So we don't make decisions based on this data, but I sure like to understand what has happened in the past. We know that things don't repeat, but they often rhyme a lot. And it's important to understand what is the realm of possibilities, especially when the world has become as bearish as it has been. So this is an interesting chart. Looks at index shorts, index and ETFs, and we know that it had been rising through the course of the summer. It has fallen quite sharply. But look at this. Single stock shorts have been rising since last February, almost on a straight line. Well, that must have been a tough day to be short a bunch of single stocks today, because frankly, while a bunch of good stocks rallied, some of the stuff that was most shorted absolutely took off like a rocket today. So I think that there was a lot of short squeeze. The Russell 2000 had its biggest outperformance day, I think, ever. It was a 4 standard deviation move. The Russell wound up 5.5% on the day. S&P had a great day, up 2%, but 5.5%. A lot of that had to do with the fact that people were short small cap stocks. When we look at what was happening in the options market last week, people went out and bet on puts, betting the market was going lower. Again, must have been a tough day to be long a bunch of puts. Outside of the US, Japan continues to truck along. This is the DXJ, which is a currency hedged Japan ETF. We mentioned the fact that Warren Buffett had been a significant buyer over the last 18 months of Japanese stocks, and we're basically on 52-week highs. India also performing quite well, both outperforming the US market so far year to date. And we highlighted last week that after a very long bear market starting in 2008, Brazil looked as though it might be starting to make a turn today. It poked its head up above this consolidation pattern that has been in. I think that's significant. We've talked over the last year about the fact that when global stocks start to outperform US stocks, often it goes on for a long time. And this probably represents the end of a secular bear market in Brazilian stocks. We have owned the ILF, which is the Latin America ETF, now for a number of months. We added Brazil last week. We'll see. Brazil does have a lot of makeup from commodities and basic materials in the mix. On fixed income, generational low in yields in 2020, like we saw in the late 1940s. We've had a very, very sharp rally in yields, or a really difficult bear market in bonds, 3 years of negative returns. We had a near-term peak in yields in October of 22. We had another peak in yields in October of 23, both of them where we got to overbought. We'll see where we go from here. Likely yields pull back a little bit. Having said that, again, people get out over their skis. Hedge funds, as of a week ago, had record short positions in treasury bonds. So that can make a fairly sharp move as they decide to cover. I thought this was an interesting chart. This goes back to 1941. It highlights through the last secular bear market in bonds, the 3 distinct moves down. All of them had negative returns for an extended period of time. 1954 to 1957, 35 months before the bond market got back to flat. In 1972 to 1976, and the height of the inflationary pressures in that period, 43 months of negative returns. And from 1977 to 1982, when rates ultimately bottomed, 54 straight months of negative returns. So 33 months of negative returns is a long time. It is not unprecedented. It's what happens in structural bear markets and bonds, and we keep that in mind. Just because something's moved lower doesn't mean it has to move back higher immediately. There may be other things to do. So aggregate bond index did make a lower low. We noticed some positive divergences, which probably meant we were going through a bottoming process, and we'll see where we go from here. So that's great. But having said that, still, stocks relative to bonds have been outperforming since the low in yields in March of 2020. So going back to the question, does it mean we go out and buy a bunch of bonds because yields have started to back off? Not necessarily. It may be better to be in equities, and particularly we talked about dividend growth equities, which have been outperforming both bonds and high dividend paying stocks, because at a time when inflation is a little bit more sticky, having a rising stream of income is probably a better inflation hedge. So interesting. From October the 30th to November the 14th, this was from the bottom in stocks up, S&P up 7.9%, aggregate bond index up 2.8. Great that bonds are bouncing, but better that stocks are rallying. Move on to commodities quickly. Bear market in commodities ended in 2020, had its first significant rally into the Fed tightening cycle. While the Fed was raising rates and the sharpest move higher in yields really on record, commodities remarkably held in firm, pulled back a little bit, and now over the last 4 months started to move higher again. Goldman Sachs today put out a report forecasting that their Goldman Sachs commodity index would be up 21% over the next 12 months. Now that's sharply in contrast to the folks that are looking for a recession to dampen demand for commodities. their expectation over the next 12 months is energy, oil, to be up 30.9%, or ex natural gas up 33%. Well, these energy companies are printing cash flow currently. They're expecting industrial metals to be up 17.8%. And if you take out nickel and zinc, up 25%, here copper and precious metals to be stronger over the course of the year. They highlight that the recession risks are falling. So their view has been that the chance of a recession has steadily been falling since March of 2023 and currently sits at about 15% chance of a recession in the year ahead. Now, Bloomberg consensus is higher than that, but also consensus that the US economy heads into recession is now in and around a little over 50%, but that has been falling. Well, that has positive implications if people have made bets that there would be a recession. We know that financial players use commodities as a way to trade against an economic scenario. So if the expectation was recession and they were perhaps shorting commodities to take advantage of what likely would be lower prices, perhaps that means they have to repurchase. Or if corporations were holding back on inventories, they might need to restock. We know the reinvestment rate of energy companies back into the ground to make sure they're replacing reserves has been falling now since 2014. Is going to take some time to ramp that back up. It's the same across most of the commodity groups. And this is happening at a time when growth in demand out of China in their attempt at a reboot is likely to be significant for oil, for copper, for coal, and liquefied natural gas. So once again, when commodity prices start to outperform stocks, it generally goes on for a long time, and we're relatively early in what is likely a new secular bull market in commodities. I am frankly surprised, despite the fact that we've been bullish on commodities, that they held in as well as they did through the course of such a tight Fed tightening cycle. So, a lot of opinions out there, some good, some bad. We have to have a process to make decisions. Our view is we don't have to be everywhere. Our job on behalf of our clients is to try to identify the areas of the market that we can invest in that have a structural tailwind, things that can lead to the upside. So what is a characteristic of leadership? Well, one of the characteristics is when the market strengthens, leaders should strengthen more, and they should be quick to go back to new highs when things get a little bit better. We don't have to be everywhere. We try to identify those groups. We watch for change, which is one of the reasons I do this webcast every week. In the absence of leadership, have a willingness to sit on cash. So we do try to take a tactical approach. There's one approach that says you're going to plug a bunch of holes. You're going to have a US equity manager and a global equity manager and a long short manager and a bond manager and just cover all the bases. Our view is that we should be tilting portfolios in the direction of the long-term themes. We don't have to be everywhere. We have a top-down view that takes all the different neighborhoods we could focus in to try to drill down to a small number of areas that have a structural tailwind where we can see money being put to work. And then we try to identify opportunities from single securities that are good getting better, where fundamentally things are improving and technically they're sound, to find a small number of securities that we can use to express our view within those groups that we're focused in, and that's where our portfolio lives. It's a living, breathing thing. The portfolio changes over time. Sometimes in a volatile market, it changes more quickly. Sometimes once we get into a trending market, we'll wind up with the same positions for an extended period of time. But the most important thing in managing that inventory is being a good seller. If you run a store and you've got inventory on the shelf that isn't selling, your job is to mark it down and get rid of it. Yet people in their portfolios have this view, well, I have to be a long-suffering holder. I'll be a holder until it gets better in the future. And if you ran a store that way, of course, you don't make any money. So we have a very disciplined selling strategy. We use stop losses. The goal is to try and minimize declines when they take place, make sure we don't make little mistakes into big mistakes. And using stops really helps that. From a top-down perspective, We're always looking for parts of the market that have become sold out, where we see the beginning of good things. What do I mean by that? In a healthy area of the market, we should see over time a higher and higher percentage of securities start to perform well. In a period of time where more and more stocks are performing well, that means breadth is expanding. It's getting stronger. More and more companies participate. There's no bear markets ever took place while breadth was expanding. We spent a lot of time trying to understand what's happening under the surface. Very often late in the cycle, while the leaders continue on, the weaklings will have started to fail and sell off. But you don't see that when you're staring at an index. When you see breadth start to deteriorate, it means that the ice is getting thinner under your feet, and you should be more cautious. So when we see deterioration in breadth, what does it mean? It means we got to raise a bit of cash. It means we got to tighten up the stop losses on our individual positions. And to the extent we get stopped out, no new money gets put to work. Okay, so this is about having process to make sure we don't make big mistakes. Now, as of 3 weeks ago, all of our breadth indicators that we track were sloppy. Percent of stocks in uptrends for Canada, for the NYSE, and globally had been deteriorating, meaning fewer and fewer stocks were holding up in price, while a larger and larger percent of stocks were breaking down and selling off. That's a period of time we don't want to add new positions. Our short-term indicators, percent of stocks trading above the 50-day, percent of stocks with positive weekly price momentum, percent of stocks making new highs versus new lows, and percent of stocks trading above their 150-day or 30-week moving average, all had been weakening. Now, 3 weeks ago, we saw an improvement in our short-term indicators. As of last week, we highlighted that all of our key indicators, long and short-term, had turned up. And this week, things moved further. Percent of stocks trading above the 50-day is all back to almost to 50%. Percent of stocks with positive weekly momentum, over 70%. Percent of stocks making new highs versus new lows, well off the carpet. And the percent of stocks trading above the 150-day moving average, also moving higher. What does this tell us? It tells us that there is money getting put to work, that stocks that were going down had reversed, and we're seeing more positive movement. Not everything, but over 40% of stocks in the US market showing higher highs and higher lows, meaning that it's constructive behavior and we should probably be putting on new positions. As of the 30th of October, the average sector had 24% of stocks in uptrends. And all of these sectors in small k, lowercase, had been seeing deteriorating breadth. When we're at the left side of the spectrum, it means a small percent of stocks in uptrends. The further to the right you go, the stronger. Now, as of today, it's a different picture. The average sector has 32% of stocks in uptrend. Now, today is not captured in this data. Okay, big moves today. Semiconductors, one of the most important groups in the market. You can see it's sitting with the bullish percent. See if I can find them here. Here at 35%. This was in the teens 2 weeks ago. Bullish percent for the semiconductors index was up 10% today. So 10% of all the semiconductor stocks made new point and figure buy signals, meaning in new uptrends. Right. Another group that's very, very important. Wall Street had a very, very big week day today. A high percentage of stocks moving into uptrends, and significant improvement in transports, a very economically sensitive group. So over the course of the week, the average sector moved up in bullish percent by 2%. Things are moving to the stronger side. We're still led by quite economically sensitive groups on the right-hand side. You can see banks, oil service, steel, Wall Street, aerospace, builders, insurance. And at the far end of the spectrum, some of the most oversold groups today had quite a big bounce. So a little bit something for everybody. Now, the data was that CPI came in less than expected. It was expected to come in up 3.3%, came up 3.2%. That's important. CPI X food and energy up 0.2 versus expected 0.3. And on a year-over-year basis, up 4%. When we look at it broken out, almost every group got better, including the services, which largely is made up of, largest component is rent. So you can see what's happening here. You can understand why the Fed is becoming a little bit less hawkish. They will still probably say we need to see more data, but this virtually eliminated the chance of a 25 basis point hike at the end of the year in the month of December. So that's a really positive thing. It may well be that they've tightened enough to slow inflation, get it toward target, but at the same time, not put us into recession. Let's take a look at what the market had to say. Well, first of all, one of the leading groups over the last while has been energy. After a long bear market, 2014 through 21, where the energy index sold off 90%. It's been rallying since March of 2020 when rates made their low. It moved out of a bear market in 2021, made a new high, went through a tightening cycle, and many groups in the market look like this that are economically sensitive, and it traded in a tightening range until ultimately 2-3 months ago broke out of that range and made new recent highs. So the energy sector, if we look at the Canadian energy sector, trading better than 82% of stocks in the S&P over the last 52 weeks. We talked about uranium. Again, new relative highs this week. Some of the companies like NextGen and Cameco did make new all-time highs. This was a really important move. It's an energy sector that is a little bit greener and again moved out of a secular bear market. So energy continues to be constructive. Technology. That's a big part of the market. And there's a lot of expensive companies. The XLK is an ETF made up of the largest of the large cap ETFs. Today, trading better than 93% of companies in the S&P on a whole, and we made new all-time highs in the XLK. Now, this is really relevant. I've talked before about the price pattern called a cup and handle, where a group of companies or one company pulls back over a period of time, in this case, starting in December of 21, traded back to March 23, forms a little handle. And when ultimately you break out of that handle to the upside, it's a very powerful signal that we are likely moving higher. As of last week, a number of the largest of large cap tech stocks had broken out, like for instance, Microsoft, out of a consolidation. And when we look at what's happened over the week, semiconductors had one of the biggest moves. This is one of our biggest positions, Broadcom, AVGO. You can see after consolidating from May in a very tight sideways range until October, broke out last week, and we're now trading at new all-time highs. NVIDIA, one of our 5 largest positions in the firm, again, very strong relative strength move over the last 2 weeks. And we report earnings. I think we get them in 6 days or 7 days. Certainly the AI theme does not appear to be going away, and importantly held this gap that opened up during the May earnings report period. Microsoft, new all-time highs. Palo Alto Networks, very close to new highs. The cybersecurity companies, and led by Palo Alto, also acting really well. So tech as a group continues to be very strong. Insurance, another group, quickly to new 52-week highs. So Fairfax Financial is the largest single position in the firm. It's been a very steady performer since the market lows in October of 2022. Has not pulled back much. One of the things we watch for is a very tight price pattern. The less volatility that you see in a price pattern, the more buyers there are underneath the surface willing to buy every time you see it pull back. So the fact that we're basically trading at 52-week highs on a resumption of strength in the market, very attractive. JP Morgan's the only major bank that we own. It maintained a higher relative strength from the market lows. We're still a ways from making new highs, but it's about the best performing, well, by far the best performing bank in the US. Moving away from financials, industrials relative to the rest of the market made new highs today. It's been led by aerospace and defense for obvious reasons. a sharp move higher in relative strength since the market made its low. Again, basically back to 52-week highs. So defense continues to be a really important group for the market. But outside of that, we're seeing strength in engineering. This is one of our larger holdings, Howmet Aerospace. They make engine parts for jets. New 52-week highs today. And I just wanted to highlight Stantec, which is one of our top 10 positions, made new 52-week highs yesterday. Okay, materials. Materials has been a battleground sector. A lot of people with the view that if we head into a recession, materials would get hurt. So uranium was the first of the materials group to break out of this tightened consolidation. That happened about 6 weeks ago. Steel. This is the bear market that went on from 2012 through 2020. Held up remarkably well through a tightening cycle. We are now a whisper away from making new all-time highs. We are in the early stages of a new bull market here. Forest products. Again, after a 10-year bear market and a tightening consolidation through the course of the Fed's tightening cycle, this week broke out to new recent highs, and that takes it out of this consolidation, likely means we're in the next move higher, which raises metal and mining. Copper has been in a very tight consolidation, and as of midway through today, we were pushing up against the top end of that band, again, having gone through a Fed tightening cycle. Remarkable that these companies have held in as well as they have. There was some good news for Teck Resources today. That looks like they've done a deal to sell their coal business, which now will make them a pretty pure play copper producer. So very, very positive outlook for all of these groups. Communications. Communications is made up of two disparate groups. You've got telecom, which has been a very poor performer, and new communications, which is, Google and Meta and Netflix. So new 52-week high for the group today. Meta making a new 52-week high, very quick off the lows back to new highs, and Google doing the same thing. Moving to the consumer. Now, this has confounded me. The home builders and the home construction material companies were one of the only groups after the lows in early 2022 to go on to make 52-week highs. You wouldn't expect this, not with what interest rates have been doing and what mortgage rates have been doing, except the fact is there's not very much for sale in the US. 30-year mortgages mean that only 3% of mortgages roll over each year, and most people don't want to give up a low rate mortgage. So if they're going to buy a home, they're going to buy a new home with a new home manufacturer is subsidizing the mortgage costs. So very sharp move higher over the course of the last week, just very close to a relative strength new high. Surprising, really, but we're now within a whisper $2 of making a new high. And also within the consumer group, one of our newer holdings, Uber, after reporting their first profit, looks like they've got a big ramp in cash flow coming very quick to make new all-time highs. So we don't need 300 companies to build a portfolio. We need 20 to 30 great companies. We have a lot of dividend growth exposure. We have a lot of exposure to companies that don't need financing and generate more than enough cash to grow their companies. There are a lot of things going on that are positive outside the first big 5 tech stocks, and Lilly is another. I put this up as a little bit longer term view, 2019 through the present, but clearly things are going well at Lilly with their GLP-1 weight loss drugs. They're continuing to get new approvals for use for additional purposes. We also have Vertex, which outside of these, the pharmaceutical group has been quite difficult. Vertex has compounds for Alzheimer's, which are winning, some significant approvals. So as we always do, let's come back to our holdings. Current holdings are technology is now our largest group. It's up a little over the last month. We've added a little bit more exposure. We've had some organic outperformance. Financials is a larger than sector weight, has been largely insurance. I know we did add some Power Corp today, which has a really nice dividend growth profile to it. Government bonds are 15%. Largely, those are held in balanced accounts, and in general, we're only about 3 years to maturity. A 15% weight in energy has been a really good one to us through the course of the late summer, early fall. I'll make a note that as per the Trader's Almanac, as of today is the seasonal low for energy. Having gone through the shoulder season, we'll see whether things firm up. Energy's been higher over the last 4 days. Corporate bonds about 7%, again, short-term maturities. Materials a significant overweight. Industrials a little bit underweight. And healthcare has been growing as Lilly and Vertex have been performing well. At the other end of the spectrum, really nothing to speak of in real estate, utilities, small amount of consumer discretionary in the home builders, and communication services is Netflix and Google. So it's a pretty skewed portfolio. We're pretty fully invested. The earnings that have come through so far have been coming through ahead of estimate. Credit spreads have been benign. So in general, we think things are getting better now. From the 26th of July, when the correction started, to yesterday, the S&P down about 3%, the aggregate bond index down about 4%, the dividend aristocrats down about 9%. Pretty happy. Our dip in the portfolio through the correction was pretty shallow, and it's come back quite nicely. We're down about 2% over that same period. In our equity portfolios, our income portfolios up about 0.7 of 1%, which we're really happy with against the alternatives and income. And our balanced portfolios kind of down 1%. So we're now into the seasonally strongest days of the year. We have a positive backdrop from our breadth models. We have data that supports with the breadth thrust we've seen over the last 2 weeks. We likely, in the past tense, 100% of the cases since 1960 with the type of trading characteristics we've seen. We'll see. What I have said now for some time is we need to get through these corrections so that we get to the runs that come on the other side. And it looks as though we are into the next 4-year economic cycle, and it looks as though we're coming out of it positioned quite well. So we'll continue to update these, but as we talked about last week, when volatility drops into the range from sort of 10 to 18 is when you get the best run-ups in stocks. And this is what's just happened over the last 2 weeks. So there has been lots of volatility over the last 2 years to challenge us. It's been a very frustrating time to be an investment manager, and it's been a frustrating time to be a client. I think the good news is we've got a lot of stuff behind us. Probably one of the greatest disruptions globally in history, having gone through COVID and some of the geopolitical upheaval we've seen. And maybe there's an opportunity here in front of us to participate and generate some positive results go forward. If things get worse, we will get more defensive. We'll show our indicators every week. We'll show exactly what we own. But I want to thank everybody for their patience. And if there's any questions, I'm certainly happy to answer them. If you have an opportunity, follow us on Twitter for clients, or if you're not a client. We post thoughts every day. If you're looking for our contact information, you can scan this bar. It'll give you all of Barometer's contact information, and certainly happy to answer any questions. Now, surprisingly, I don't see a lot of questions. Let's just take a look another place. Oh, questions. Here we go. We got a few. One question. Do the equity balance and income pools ever invest outside North America? And do we have to get global macro to get that exposure? The most likely place you're going to get global exposure is in the global macro portfolio. Now, the global macro portfolio being invested often outside the US and in assets like commodities can be a little bit more volatile. But that being said, in an upcycle, should participate very nicely. Just slightly before 2018, that portfolio won top macro strategy in Canada over the previous 5 years. It's a interesting strategy, but that's the most likely place. In the equity portfolio, we do look at some European equities and equities from other countries. The income portfolio, we don't seem to need to look too far outside of North America here, although we can look at emerging market dividend growers. And the balanced portfolio is not likely to have a lot of global exposure. Next questions. With some in the semi sector having very high valuations, if you move into this sector, would you stock pick or buy the SMH? I think here's our tendency. When a group has been out of favor and the sector model turns positive, we often will start with an ETF and then rifle shot as things become clearer. Having gone through the most recent correction, both Broadcom and NVIDIA have been remarkably solid. And so they stayed in the portfolio despite the fact the sector was correcting. I would have no hesitation adding either of those positions to portfolios currently, because they've done exactly what they should do, and that is to go straight back to new highs the moment there is strength in the sector. If I were choosing one of the ETFs, you have to look at the makeup. The SOXX is market cap weighted and gives you a much larger weighting to the largest of the semis, which seem to have the best tailwinds, versus the XSD, which is an equally weighted semiconductor index or ETF. So the SOXX would be one way to play and get the largest of large cap names, but you're including Intel in the bunch. Next question, would we add to FFH? I absolutely would add to a large cap stock that is making new highs almost immediately when strength in the market resumes. So there's a reason why FFH is performing so well, or Fairfax is performing so well. You know, there's hardening in prices in insurance, but really what you're buying is an investment manager's investment returns. And the Fairfax management team have done a great job in building their portfolio and generating returns there. If we think the market's going to be better, their portfolio likely performs quite well. Next question. Have we added any new positions in the balanced portfolio since November the 6th? We did add some Power Corp, and I believe that we added a little bit of Rogers Communications. I think there's one other position that I'm forgetting. I apologize. I have to come back on that. And then the last thing is, historically, what has been the effect on the market when going into an election year? Well, the thing is, going into an election year, you have a lot of campaigning, a lot of promises made, and it tends to be, frankly, that the Fed is not overt in its policy. So I think one of the things that has been happening is that the Fed has been trying to get its point across and trying to mute inflation ahead of the next calendar year, where they are less likely to be in your face to the same extent during an election. So election years tend to be quite good. And I think that we are, into a stronger environment with improved breadth readings in the market, expanded leadership. And it comes after a 23-month period where the market has been choppy, which is long for a cyclical bear market. So my guess is we probably have some pretty good performance in front of us. And I want to see if I've answered all of them. Oh, how on earth could WTI be down on a day like today? So keep in mind, there's a lot of cross currents on a day like today. You can bet there was a bucket of short covering today in the market. There's a lot of people who have been really, really bearish on the outlook for the economy and for the market. One of the areas that has been strong has been energy. So if people have a long short portfolio and they're covering some shorts, they may need some capital from somewhere. They may take some money from the energy sector to cover what is something that is urgent, one of their shorts. To give you an idea, The ARC Genomics ETF today was up 8.8%. The Clean Energy ETF was up 7.5%. Equally weighted biotech ETF up 5.4%. The regional banks ETF was up 7.4%. Now, you didn't want to own these leading into today. They've been, serial underperformers, but people have made, big bets that these are shorts and that there's problems in the future. Now, with bond yields coming down, the regional banks have less pressure on their bond holdings, and that's positive. So on a day like today, don't get too caught up in one or two things that did better, one or two things that did worse. I said 3 weeks ago or 2 weeks ago, when you get several strong days in a row, wait and see what backs off on the first negative day to look at what may have been short covering, which runs its course, and what may have been real buying. Real buying tends to be those securities hold their gains when you get a weak day, whereas the things that were short covering have a tendency to give those back. So it'll be important to watch over the next few weeks, next few days. You don't have to have all the money placed on the first day. Market's going to digest these gains. You'll have a chance to make some money. Question about a company that I'm not familiar with. And I think that's it. Oh, question on stop losses. Once stopped out, is it understood that you will not go back to the same holding for some time? In fact, that's not the case. If we get stopped out of a position because technically it has become broken, and we use point and figure charts to recognize inflection points, we're choosing to make sure that a little mistake doesn't turn into a big one. If we roll forward in time, and it may not be a long period of time, and technically that security gets repaired, and fundamentally things appear to be continuing to get better. If we think it's one of the 30 best companies that we could own, and technically it gets repaired, we actually would have no problem buying that security back, even if it's at a higher price than where we sold it. The goal isn't to be right all the time, right? The goal is to use a process to make sure that you're, kind of making rational decisions and you're managing risk. So sometimes the best thing you could do is to buy something back at a higher price if it's the best position that you can find. Doesn't happen all the time, but it certainly is not something that I would say never happens. With that, I think we've come through the end of the questions. I appreciate everybody tuning in today. I hope everybody had a good day. If you've got any questions that you are shy to ask about, reach out to us. Send us an email. On that crazy barcode has my email information and all of our various contact points. Don't hesitate to reach out. Happy to answer questions. And we'll be back again next Tuesday and see what this next week brings. So thanks very much, everybody, and look forward to talking to you all soon.